In 2019, a mid-level accountant at the Department of Defense noticed something strange in a routine audit file. The numbers didn't add up. Not by a little, by $21 trillion. When she flagged it to her supervisor, she was told to move on to the next file. That missing money? It still hasn't been found. And that's just one of the stories we're about to unpack. Most people think government financial scandals involve briefcases of cash or offshore accounts in the Cayman Islands. The truth is far more sophisticated and far more boring, which is exactly why they work. These aren't heists, they're accounting tricks performed in broad daylight, buried in thousand-page reports that nobody reads, and spreadsheets designed to confuse rather than clarify. Today, we're looking at 3 financial scandals that aren't hidden because they're secret. They're hidden because they're incredibly dull to talk about at dinner parties. But the numbers are anything but dull. Let's start with the Pentagon. The United States Department of Defense has never passed a full independent audit. Never. Not once. And they've been required by law to do so since 1990. That's over 3 decades of what accountants politely call material weaknesses and what normal people would call a catastrophic failure to track where the money goes. Here's how it works. Every year, Congress approves a defense budget. For 2023, that was $816 billion. The Pentagon then distributes that money across hundreds of programs, contractors, and military branches. Sounds straightforward. It isn't. The Defense Department uses dozens of incompatible accounting systems. Some are so old they run on programming languages that universities stopped teaching in the 1980s. When auditors try to track a single transaction, say a payment to a weapons contractor, they often find the same dollar recorded differently across multiple systems, or not recorded at all, or recorded as 3 different amounts depending on which database you check. In 2018, the Pentagon finally attempted its first full audit. They hired over 1,200 auditors. The cost? $400 million. The result? They failed spectacularly. They could only verify 47% of their assets. That means more than half of the physical stuff the Department of Defense claims to own, buildings, vehicles, equipment, weapons, couldn't be properly accounted for. Now here's where it gets strange. After failing that audit and the 5 audits since, there have been no real consequences, no firings, no budget cuts. In fact, the defense budget has increased every single year. The official line is that the Pentagon is working on it. They've promised to pass a clean audit by 2028. They've made similar promises before. In 1995, they said they'd be audit-ready by 1997. In 2005, they pushed it to 2007. The deadlines keep moving, and the money keeps flowing. But let's talk about that $21 trillion figure from the beginning. In 2016, a professor at Michigan State University named Mark Skidmore started digging through Department of Defense financial reports. He found something called unsupported adjustments. These are changes made to financial statements without documentation. Essentially, numbers that got changed and nobody wrote down why. Over a 17-year period, these unsupported adjustments added up to $21 trillion. To put that in perspective, that's more than the entire U.S. economy produces in a year. It doesn't mean $21 trillion went missing. It means $21 trillion worth of financial entries were altered without proper records. The Pentagon's response was to call it a bookkeeping error, a very, very large bookkeeping error. They claimed the same money was being counted multiple times due to system errors. Maybe that's true, but here's the uncomfortable part. We have no way to verify that explanation because the systems are too broken to audit properly. So we're left with a simple question. If you can't track the money, how do you know it's being spent correctly? And if you can't answer that question, why does the budget keep growing? Let's move to scandal number 2. This one's about money the government says it doesn't have. For decades, American workers have been told their Social Security contributions go into a trust fund. The language is everywhere. Politicians talk about protecting the trust fund. News articles warn when the trust fund will run out. The Social Security Administration itself uses the term constantly. Here's the problem. There is no fund, not in any meaningful sense. Let me explain how it actually works. When you pay Social Security taxes, that money doesn't go into an account with your name on it. It goes into the general treasury. The government immediately spends it on whatever the current budget requires: roads, military, salaries, whatever. In exchange, the Social Security Administration gets a special type of government bond, an IOU. These bonds are real in a legal sense. They're backed by the full faith and credit of the United States government. But here's the catch. They're non-marketable. You can't sell them. They only have value if the government decides to honor them, which means the trust fund is really just the government promising to pay itself back later. Think of it this way. Imagine you spend your entire paycheck, but write yourself an IOU for the amount you were supposed to save for retirement. That IOU sits in a drawer. When retirement comes, you plan to honor that IOU by reducing your spending or finding extra income. That's essentially what the Social Security Trust Fund is. Now, this system worked fine for decades because Social Security brought in more than it paid out. The surplus got converted to bonds, and those bonds accumulated. By 2020, the trust fund held about $2.9 trillion in these special bonds. Sounds substantial. But in 2021, something shifted. For the first time in nearly 32 years, Social Security started paying out more than it collected. The trust fund began shrinking. The government started redeeming those bonds, which means the Treasury has to find actual money to pay back what it borrowed. Here's where the math gets uncomfortable. According to the Social Security trustees' own projections, the trust fund will be completely depleted by 2034. That's 10 years away. When that happens, Social Security will only be able to pay about 80% of promised benefits using incoming tax revenue alone. Politicians on both sides acknowledge this, but the solutions, either raising taxes, cutting benefits, or raising the retirement age, are so politically toxic that nobody wants to touch them. So instead, we get committees and commissions and strongly worded reports. Meanwhile, the clock keeps ticking. The scandal isn't that Social Security is going bankrupt. It's not. The program will continue as long as people keep working and paying taxes. The scandal is the decades-long pretense that there's a safely invested fund somewhere, when in reality it's just accounting entries that represent money already spent. Millions of Americans are making retirement decisions based on promised benefits that, under current law, cannot be fully paid, and the people who could fix it are waiting to see who blinks first. Which brings us to our third scandal. This one involves a financial instrument so boring that merely describing it makes people's eyes glaze over, which is precisely why it's been so effective. Municipal bonds are how cities, counties, and states borrow money. They issue bonds, investors buy them, and the government pays them back with interest over time. It's supposed to be low risk, predictable, and boring. For decades it was. But after the 2008 financial crisis, something changed. Cities across America were broke, pension obligations were ballooning, tax revenues were down, and they still needed to fund basic services. So some of them started lying. Not dramatically, not in ways that would trigger immediate red flags, just small distortions in financial disclosures, underestimating pension liabilities, overestimating future revenues, using accounting tricks to make balance sheets look healthier than they were. Take Detroit, for example. For years before its 2013 bankruptcy, the city issued municipal bonds while its financial statements significantly understated the severity of its pension crisis. Investors bought those bonds thinking Detroit was a relatively safe bet. They weren't told the full picture. When Detroit finally filed for bankruptcy, bondholders lost billions. Or consider Puerto Rico. The island spent years borrowing money through municipal bonds, while its government-owned corporations racked up massive debts that weren't properly disclosed. By the time the truth came out, Puerto Rico owed $72 billion in bond debt and $50 billion in pension obligations. It was the largest municipal bankruptcy in U.S. history. Now here's the twist.
Unlike corporate bonds, municipal bonds have historically operated with far less regulatory oversight. The Securities and Exchange Commission has some authority, but enforcement has been inconsistent. Many cities issue bonds with financial disclosures that would never pass muster in the corporate world. And when cities do get caught misrepresenting their finances, the penalties are usually modest. In 2014, the SEC charged the state of Illinois with securities fraud for misleading bond investors about the state of its pension system. The settlement? Illinois agreed to improve its disclosures. No fines, no criminal charges. This creates a perverse incentive. Cities facing budget crises can issue bonds with rosy projections, knowing that even if they get caught, the consequences are minimal. And investors, chasing the tax-exempt income that municipal bonds provide, often don't scrutinize the financials as carefully as they should. According to a 2019 study by the Brookings Institute,